Hello fellow intelligent investors, my name is René Zellman, and in today's video I want to discuss why stocks go up. Why does the stock market, over the long run, always increase in value? And how and why has the S&P 500 compounded at a return of roughly 10% per year for decades? Well, in this video I want to present 4 reasons why the stock market keeps rising over the long term. So without further ado, let's get started.
Have you ever wondered how you can make your hard-earned money work for you? Have you ever dreamed of building generational wealth and leaving a legacy? My name is René Zellman, and I'll teach you how you can manage and invest your money with confidence, a long-term vision, and without losing your mind. Join me on my journey of intelligent investing and learn how smart people can compound their money effectively and accumulate wealth.
Alright fellow intelligent investors, so what I've mentioned in previous videos is that over the last 100 years or so, US equities, so stocks, have compounded at an annual growth rate of roughly 10%, including dividends I should say. Sure, there has been significant variation in year-over-year returns, so stocks don't go up every year, but the market goes up over the long run, and so this means that there have been more up years than down years, as has been visualized by this chart here. So over the long run, stocks seem to be the asset class that you want to be invested in. In my last video, I actually referenced the following tweet by Brian Ferroli. The stock market isn't risky. The stock market only becomes risky when your holding period isn't long enough. And if you consider the following long-term chart of the S&P 500, you have to agree with Ferroli. The longer your investment time horizon, the higher the probability that you will earn a positive return. And the same can be said about other stock markets too. The MSCI World Index, for example, is often used to represent global stock markets. And it includes thousands of the largest companies from all over the world. As you can see, the MSCI World has also had its up and downs, but it recovered from all of the down years or down decades or down periods and went up over the long term. And this pattern can also be observed when looking at regional stock market indices, such as the German DAX, the Shanghai Stock Exchange Index, the Chinese CSI 300 Index, the Indian BSE Sensex Index, the Canadian S&P TSX Composite Index, or the British FTSE 100 Index. However, not all stock markets tend to go up over time, as the example of Japan shows. But if we just focus on the US here, where does that extremely satisfactory US broad market return of 10% per year come from? It almost seems like the fact that the S&P 500 will continue to grow in the long term is like a natural or physical law. The Earth is having a gravitational strength of 9.8 meters per second squared, and the S&P 500 has an average annual return of 10%. Well, I would like to put forward 4 explanations in this video in order to explain this phenomenon. And actually I think the last one is the most fascinating one, so make sure to watch the video till the end. Well, but let me start with the first one, the first explanation. Well, first of all, the 9 to 10% compounded return that I just mentioned is a nominal return. And put simply, nominal rate of return refers to the gains generated by an investment before factoring in inflation, but also before taking into account other expenses such as taxes or investment fees. So some of the growth in stock values has to be attributed to inflation. Inflation can be defined as an increase in the general price level of goods and services. And now obviously when prices rise steadily, companies will obviously generate higher revenues and higher operating profits over time. And when companies increase their revenue and profit, over the long term, their stock prices will obviously eventually follow. Between 1914 and 2021, for example, the long-term average inflation rate in the United States has been 3.23%. According to central banks around the world, an annual inflation rate of 2 to 3% is ideal. However, we have seen quite a spike in the inflation rate in recent months in the United States, and investors start worrying about the long-term economic implications of this development. And if you want to learn how investors, so how you can prepare for inflationary periods, I highly recommend the following video that I did on this subject. Anyway, the key takeaway here is that part of the rise in broad stock market indices can be attributed to inflationary forces. And as a consequence, real returns that are adjusted for inflation tend to be a little lower, and achieving superior real returns is what investors should actually focus on. Alright, if we now focus on the second reason why the stock market has gone up over the long term, for a couple of decades now, then we need to talk about population growth. As of July 2021, the world population is at almost 7.9 billion people. The global population has grown from around 1 billion in 1820 to 7.9 billion today. And if you study the demographic history of countries, one key takeaway is that population explosions tend to be temporary. For many countries, the demographic transition has already ended or will be ending soon. And according to data provided by the World in Data, it is likely that we are approaching the end of the rapid population growth that we have experienced in recent years and decades. But nonetheless, one can expect that the world population will continue to grow at a slower pace, but will continue to grow for some decades, before eventually topping off at 11 billion by around 2100. But when it comes to such long-dated forecasts, personally I tend to be very skeptical, and I always wonder how reliable these forecasts actually will turn out to be. Nonetheless, to get back to the topic of this video, an increase in the world population means that there is a larger total addressable market for companies, for businesses. Generally speaking, total addressable market, or for short TAM, refers to the number of people that might be interested in a company's products or services. The total amount of demand that exists for a product or service. And obviously, if a company can sell its products to 1 billion people, it is more valuable than a similar company that sells a similar product with similar margins to only 10,000 potential customers. And so if the overall population, and thus the total addressable market, is growing over time, companies' revenues and profits in aggregate will increase over the long run as well, which will then result in higher stock prices. According to the World Bank, the US population is growing at 0.5% annually. And this might not sound like much, but nonetheless it contributes to the uptrend of the US stock market. In his 2016 annual letter to shareholders, Warren Buffett himself explained how population growth contributes to more prosperity. He wrote the following: America's population is growing about 0.8% per year, 0.5% from birth minus death, and 0.3% from net migration. Thus, 2% of overall growth produces about 1.2% of per capita growth. That may not sound impressive, but in a single generation of, say, 25 years, that rate of growth leads to a gain of 34.4% in real GDP per capita. In turn, that 34.4% gain will produce a staggering $19,000 increase in real GDP per capita for the next generation. All families in my upper middle class neighborhood regularly enjoy a living standard better than that achieved by John D. Rockefeller Sr. at the time of my birth. Rockefeller certainly had power and fame. He could not, however, live as well as my neighbors do. Okay, and this brings us to the third and maybe most important source of the aforementioned broad market return, and that's productivity growth. More specifically, productivity growth of the US economy when we are focusing on the S&P 500. But more generally speaking, productivity growth of the developed world, or the economies in the developed world, if we would focus on the MSCI world. Put simply, productivity growth refers to an increase in output per unit of input, such as labor, capital, or other resources. And obviously, such an increase will have a positive impact on businesses. After all, stocks represent an actual ownership stake in companies. And obviously, a broad basket of stocks can only go up over such a long period of time if productivity increases, and thus the efficiency and earnings power of companies. Now, interestingly, the second and third explanation that I mentioned may actually be intertwined. Population growth may actually be related to improvements in technology and productivity, as statistically speaking, the more people there are on our planet, the more geniuses and inventors will be among the human species. Productivity growth is achieved by technological advancements. For example, working from home, also known as telework, has become much more common during the COVID-19 era. Once we've successfully battled the virus, widespread telework may remain a permanent feature of the future working environment, as companies have gathered experiences with teleworking during the pandemic, and they may recognize some of the advantages that come with this form of work. According to the report Productivity Gains from Teleworking in the Post-COVID-19 Era by the OECD, more widespread telework in the longer run has the potential to improve productivity and a range of other economic and social indicators. Worker well-being, gender equality, regional inequalities, housing, emissions, even though its overall impact is ambiguous and carries risks, especially for innovation and worker satisfaction. But that's just one example of how technological progress can boost overall productivity. If we just take a look at history, then we can see that as the world population has grown exponentially, the speed of human progress and innovation accelerated as well. During the industrial age, we made tremendous progress due to the steam engine. The invention of the railroad and the steam-powered locomotive fundamentally changed modes of transportation and logistics. The invention of the light bulb extended the productive hours of human beings into the night. Later, we changed our mode of transportation again with the invention of the car and airplanes. We changed the way we communicate as the telephone and later smartphones were invented. And nowadays, apps on our mobile phones enable us to search and find information to an extent that was basically unimaginable only a few years ago. One way to measure and visualize innovational progress could be the number of patents that are or were issued per year. And this chart right here visualizes that long-term uptrend in patents issued. Now, another interesting point that I wanted to bring up here is that in a recent Patrick O'Shaughnessy podcast, his guest Mark Andreessen actually pointed out that the measurements of productivity growth have been falling for decades now. Labor productivity growth has been trending downward in the developed markets, but also in China for many years already. And this can be considered quite a puzzling development, considering the rapid pace of high-tech innovation or innovations that we have experienced in recent years. So technological innovations may not always lead to higher productivity. And quite frankly, I have no explanation for this, and any explanation would probably go beyond the scope of this video. So I'll just leave it there. Just wanted to put out that thought. Well, nonetheless, over the long run, all of the aforementioned innovations resulted in an ever-increasing quality of life and significantly higher productivity. So again, a much higher output per unit of input. I think the progress made by humanity is nothing but impressive. So the bottom line here is certainly that as long as human ingenuity continues to produce attractive new innovations, companies will become more efficient and more profitable, and so stocks will go up. If we just consider the potential of self-driving cars and AI, I think the future of humanity looks bright, and the impact of these technologies on a range of industries will be profound, even though it will be hard to predict. And to wrap up this third point, let me once again quote the legend Buffett himself. In the aforementioned Berkshire 2016 shareholder letter, Buffett wrote the following: American GDP per capita is now about $56,000. In real terms, that's a staggering 6 times the amount in 1930, the year I was born. A leap far beyond the wildest dreams of my parents or their contemporaries. US citizens are not intrinsically more intelligent today, nor do they work harder than did Americans in 1930. Rather, they work far more efficiently and thereby produce far more. This all-powerful trend is certain to continue. America's economic magic remains alive and well. Okay, lastly, I would like to present a fourth explanation for why major stock market indices have been trending upwards for multiple decades. Well, I should point out that not all companies benefit from technological advancements and subsequent productivity growth. And this phenomenon is best known as Schumpeter's process of creative destruction. And what this phenomenon or concept describes is that innovations do increase overall productivity, but that the process of innovating inevitably will also destroy existing and well-established industries and obviously individual companies. It is essentially destroying poorly performing companies and reallocating resources to more productive, innovative, and maybe we could just say winning companies. As the paper Productivity Growth and Stock Returns, firm and aggregate level analysis shows, a few technology winners stocks rise with their rising productivity, while many technology losers stocks fall with their declining productivity. Thus, most individual firms' stock returns correlate negatively with aggregate productivity growth. This implies that technological innovation need not to be a blessing for all firms. So one final reason why the S&P 500, for example, shows a long-term uptrend is that the S&P 500 constituents or components actually change over time. The S&P 500's constituents should be a good representative of different industries like technology, healthcare, financials, communications, and so on and so forth. And the S&P index includes 500 of the largest companies whose stock is trading on either the New York Stock Exchange or the Nasdaq. But the components of the S&P are not necessarily the 500 largest companies. The components of the S&P are actually somewhat subjectively selected by a committee. Tesla, for example, has only recently been added to the S&P, despite its market capitalization of hundreds of billions of dollars. So, most broad market index funds do not represent a fixed set of businesses. No, they experience quite a lot of turnover. The S&P of today is very different from the one 10 years ago. The S&P 500 actually regularly drops losing or underperforming companies and replaces them with more innovative, up-and-coming companies. I actually came across an interesting statistic when I conducted my research for this video. According to Goldman Sachs, and as shown in this graph here, on average, more than 35% of S&P 500 constituents have been turned over during 10-year periods following 1980. And according to the consulting firm InnoSight, in 1965, the average tenure of companies in the S&P 500 was 33 years. By 1990, it was 20 years, and it's forecast to shrink to 14 years by 2026. So, broad stock market indices also rise over the long term because they always comprise the best companies in the market, and they drop the losers. Of all of the mentioned reasons, I think this fourth one is probably the most insignificant factor, but I still wanted to mention it in this video, as many people probably did not know that the composition of many index funds is actually quite dynamic. So, what's the key takeaway here? Well, I think the US stock market tends to rise over the long run, and as we've outlined, there are 4 explanations for this phenomenon. There are certainly other factors at play here, but I think those are the most dominant ones. However, not every stock market around the world rises over multi-decade periods. The most prominent example is probably Japan's stock market, which still hasn't recovered from the mother of all asset bubbles in the early 1990s, during which real estate and stock market prices were greatly inflated. Sure, extreme valuations back in the early 1990s are one explanation for this multi-year, or multi-decade I should say, poor performance. But an aging population and a chronically low inflation environment, So two of the factors that we talked about in this video, they certainly also play a role here. And in terms of productivity and labor productivity specifically, and efficiency, Japan was actually a global leader in the past. But in 2018, Japan's labor productivity was among the lowest in the G7 developed economies and among the lowest of the OECD. So another key takeaway here is that not every stock market is created equal. Obviously, the S&P has delivered some magnificent returns for a very long period of time. But stock markets only go up in fundamental value when the underlying factors that we have discussed in this video create the right conditions for long-term economic growth and innovation. And this is why selecting the right stock market to invest in is actually so critical for passive investors. And this is also why Warren Buffett keeps saying that he is a big believer in the US stock market. And with that, I think I will wrap it up here. As always, may your finances and investments prosper. Good luck.